Are we witnessing the fall of the dollar, or is this simply a geopolitical game? For decades, the US dollar has been the backbone of the global financial system, used in trade, reserve holdings, and international transactions. But today, that landscape is beginning to shift, as China is carefully building a new strategy to elevate the yuan onto the global stage. At the same time, several countries are starting to reduce their dependence on the dollar, whether for economic or geopolitical reasons. This change is not happening overnight. It is gradual, but consistent. So in this video, we will explore whether the yuan is truly ready to rise as a global power currency. Stay tuned. To understand how China is attempting to replace, or at least reduce, the dominance of the dollar, we first need to understand why the dollar became so dominant. After World War II, the United States emerged as an unmatched industrial and financial superpower. Through the Bretton Woods Agreement, the dollar was established as the world's primary currency. Other currencies were pegged to the dollar, and at that time, the dollar itself was backed by gold. Even when the link between the dollar and gold was abandoned in the early 1970s, the dollar did not collapse. Instead, it became more flexible, yet remained dominant due to the strength of the US economy. Oil-producing nations also adopted the dollar as the standard currency for oil transactions, giving rise to the petrodollar system. Since then, anyone wanting to purchase oil and major commodities at scale needed dollars. This became the foundation of dollar hegemony. It is within this system that China began to rise. As China grew into the world's export powerhouse, factories in Shanghai, Guangzhou, and Shenzhen produced goods for global markets, and most payments were made in dollars. As a result, China's foreign reserves surged to trillions of dollars, much of it held in US government bonds and dollar-based assets. On one hand, this gave China enormous financial strength, but on the other, it also revealed how deeply China remained tied to the dollar system. Every time the Federal Reserve adjusted interest rates, the effects were felt in Beijing. And when the United States imposed financial sanctions on its adversaries, China could clearly see that the dollar was not just a currency, but also a tool of global power. The 2008 global financial crisis became a turning point. The collapse of financial institutions in the United States spread across the world and shook confidence in the existing system. Although the dollar remained dominant, China began to see a major risk: overdependence on another country's currency. From that moment, Beijing started moving more strategically to elevate the yuan globally. The goal was not to suddenly replace the dollar, but to build a strong enough alternative, so China would no longer be overly dependent or vulnerable to pressure from a system shaped by others. China's first step was to push the yuan beyond its borders through trade. The government allowed companies to use yuan in import and export transactions, reducing reliance on the dollar. At the same time, China's central bank signed currency swap agreements with trading partners. This allowed those countries to access yuan directly for trade with China, without needing to hold dollars first. Meanwhile, Beijing gradually opened its financial markets to foreign investors. The objective was clear: to ensure the yuan is not only used for trade, but also held as a long-term asset. A major milestone came when the International Monetary Fund included the yuan in its special drawing rights (SDR) basket. This placed the yuan alongside the dollar, euro, pound sterling, and yen as a global reference currency. Since then, more central banks have started holding yuan as part of their reserves, although still in small amounts. But in terms of perception, this was a significant step in transforming the yuan from a regional currency into a globally recognized one. At the operational level, changes are already visible in trade and payment statistics. Where once almost all of China's cross-border trade was settled in dollars, a growing portion is now conducted in yuan, or a mix of yuan and local currencies. The yuan's share in global payments is still far behind the dollar, but it has grown from nearly 0 to several percent in less than 2 decades. Today, the yuan ranks among the most actively used currencies in cross-border payments, surpassing many other popular currencies. From a strategic perspective, every percentage increase means a small portion of the dollar's dominance is being replaced by China's currency. One of the most cited examples of the yuan challenging the dollar is China's relationship with Russia. After Russia was hit with major financial sanctions by the United States and Europe following the Ukraine conflict, many Russian banks and companies lost access to the dollar and euro systems. In response, Moscow moved closer to Beijing. Trade between the two countries reached record levels, and more importantly, the currencies used began to shift. Today, a large portion of transactions is conducted in yuan and rubles, rather than dollars. In Russia's financial markets, the yuan has even become the most widely used foreign currency, surpassing the dollar. From China's perspective, this demonstrates that the yuan can function as a viable alternative, especially for countries excluded from the Western financial system. However, the Russian case also highlights a key reality. Replacing the dollar is not easy. Russia shifted to the yuan not necessarily because it is more stable or trusted, but because access to the dollar and euro was cut off. For most countries that are not under sanctions, the dollar remains the preferred choice, and for good reason. The US financial market is massive and highly liquid, allowing investors to move in and out easily. US government bonds are considered among the safest assets in the world. Additionally, the US legal and financial system is seen as more transparent and predictable, even if not perfect. In contrast, the yuan still faces limitations. Capital flows are tightly controlled. The government heavily influences exchange rates and interest rates, and financial markets are not fully open. Recognizing these limitations, China is not relying solely on trade and investment. It is also building its own systems in international payments. In regions like Southeast Asia, China is expanding the use of UnionPay card networks and cross-border QR payment systems. This allows people to transact directly without converting to dollars first. While these changes may seem small, they could have a major long-term impact. Because the fewer transactions rely on the dollar, the less influence it holds over the global financial system. China is also leveraging its position as the world's largest oil importer to develop the concept of the petro-yuan. For decades, most oil trade has been conducted in dollars, sustaining constant global demand for the currency. China is now using this leverage to negotiate with oil-producing countries, offering long-term purchase agreements paid in yuan. Countries that accept yuan gain advantages, including easier access to China's markets and investment opportunities. Although the dollar still dominates global oil markets, the emergence of yuan-based oil transactions signals an important shift. The petrodollar system is no longer absolute. On the technological front, China is advancing with the development of its digital yuan, or ECNY. In the short term, it helps the government manage domestic money flows more efficiently. But in the long term, it has the potential to facilitate international transactions without relying on Western payment systems. If integrated with other countries' systems, it could create entirely new pathways, where transactions occur without involving the dollar, instead using China's own digital infrastructure. So with all these developments, the question remains, is the dollar being replaced by the yuan? The more accurate answer is, not replaced, but gradually weakened. The dollar remains dominant, but it no longer holds the same monopoly as before. In terms of numbers, the dollar still leads by a wide margin in central bank reserves, global payments, and financial markets. The yuan, while growing, remains relatively small in most key metrics. However, major shifts in the global financial system rarely happen suddenly. They unfold slowly, through consistent, incremental changes. Every trade that no longer uses the dollar, every central bank that begins holding yuan, and every payment system that enables direct yuan transactions all contribute to the same direction, reducing global dependence on the dollar. For developing nations and middle powers, this shift creates more options. They are no longer tied to a single system and can transact using dollars, yuan, or local currencies depending on the situation. This flexibility helps reduce risk, especially if major powers use currency as a tool of pressure. However, it also makes the global financial system more complex. Every decision now involves more variables, including geopolitical considerations. The transition toward a multi-currency system may not be easy at first, but it reflects a new reality, a world increasingly divided into multiple economic power centers. rather than just one.